Welcome to the Money Show, your ultimate guide to navigating the world of personal finance. So whether you are looking to grow your wealth, secure your future, or just make smarter money moves, we've got you covered. From market insights to expert tips and everything in between, this is where we decode the secrets of financial success. I'm Kavita Thaplial, and let's get started. And before we begin, just in case, because we do your life financial planning on the show as well, we answer your portfolio queries on the show. So you want to send across your questions, you can WhatsApp us your queries on 86579745571, and we also have an email ID which is themoneyShow@etnow.tv where you can send across your questions. All right, so let's begin the show. And the markets have experienced significant volatility lately. Now, despite this, now SIP numbers remain quite encouraging, or one can say less disappointing than expected. In March, SIP contributions declined to almost 25,926 crores, representing a 14% drop in equity inflows. I'm talking about the AMFI number, which we'll be flashing on the screen as well. The equity inflow has gone down to almost 14%. However, small cap funds demonstrated resilience, seeing a 10% increase compared to February. On the other hand, 5.1 million SIP accounts were discontinued, a noteworthy development. Now, in last 6 months, major indices have taken a hit. Nifty down by almost 10%, mid-cap 150 index by 16.5%, small-cap 250 index has suffered a staggering drop of almost 20.9%. Now, this creates challenges for SIP investors striving to remain steadfast in the market. The question arises, does stopping your SIP makes sense now? Could it lead to losses? Or perhaps, is this the time to step up your SIP investments? Now, let's dive deeper and decode these uncertainties. Joining me today on the show is Shweta Rajani, Head of Mutual Fund Annuity Wealth. Shweta, looking at the numbers on the face of it, at least the AMFI numbers in terms of SIP investors, they don't look worrisome so far, okay? Because we were expecting a much deeper drop in SIP investments per month, but then we are still holding on to 25,900 crores very strongly, which shows a resilience in the market. But then, having said that, we are also seeing dip in equity flows, and we are also looking at SIP discontinuation of almost 51 lakh accounts. Does this bother you?
Good evening, Kavita. So yes, the positive is that we've seen, more of your retail investors being fairly resilient. They're showing actually a very matured behavior, understanding that the benefit of SIP is seen in such markets where we say, the rupee cost averaging plays out, and therefore when markets are volatile is when they should continue or step up their SIPs. That I think I'm seeing a lot of investors following, which is where the SIP numbers at 25,900 continue to be there. On the other hand, you also have another number, which is discontinuation of SIPs. Now, I'll break up that discontinuation into 4 possible reasons of why this could have happened. One is, your SIP tenors come to an end, so there's been some stoppage of SIPs, and which is very likely in the month of March. People generally start their plans and SIPs in April, continue it for 12 months, and then they restart their SIPs. So that could be one possible reason. People would have achieved their goals, so they're discontinuing their SIPs. It could also be a rebalance where you're shifting from one scheme where you were doing an SIP, you're now shifting that lump sum to another scheme. Fourth, it could be cases where you are worried about markets and therefore you are stopping your SIPs, halting your SIPs for some time. The good part over here also is that if I see the discontinued SIPs in Feb was 61 lakh folios, now it is 51. So it's compared to the Jan number, little lower number from that standpoint. So these are the 4 possible reasons. I'm hoping most of it could be the first 3 that I said, and less of the last case where an investor is worried and therefore stopping the SIP.
So when we talk about discontinuing, Shweta, when we talk about discontinuing the SIP accounts, this doesn't necessarily mean that the person will not come back to the market again or has to stop investing. What I also want to understand, the SIP numbers means fresh money into the market in the same portfolio. In the same folios, we're talking about new folio addition also. And if there is a number to folio addition, would you be having that?
So what I was seeing on AMFI is the new folio addition, the new SIP folios created is also somewhere around 41 lakh folios that have been added through the SIP route, and 51 lakh on the discontinuation side. So this in Jan, if I see the number of discontinued folios stood at 61 lakh crore, and the new folios added in the month of Jan or Feb were upwards of 50 lakh folios. So to that extent, newer folios added are less, but the SIP amount remains same. So I'm assuming people have done step up to their SIPs in this market. That's, I think, one interesting data point.
Sure. Let's also talk about the category preferences that we saw in the AMFI numbers also. FlexiCap, as we all know, has again shown a very strong inflow number. Small caps have risen 10% as compared to Feb. Now, what is this new kind of a trend? Are we talking about new money or new SIPs in small cap, fresh money coming in small cap funds?
Yes, so flexi cap, given the market situation, also when it is volatile, the easiest is to get into a flexi cap category and leave it to the fund manager to decide which market cap he wants to allocate, where the fund manager deems fit. Also, most of the flexi cap funds have a large cap bias. On an average, as a category, if I see, roughly 70 odd percent would be getting invested in large caps within a flexi cap category. So it kind of is comforting at this point of time to be in this category, which is where you see flexi cap receiving, the maximum flows. Small cap, I would say, I think, the reason why investors were worried and we in between saw a reduction in the flows coming in was valuations as a concern and profitability a concern over here. Plus, small caps, if you see from the last financial year onwards, had seen a significant run up in their prices. So these were three factors. And now if I break down each of these three factors, we've seen small caps correcting from their peak levels to the extent of 20-21%. That has brought valuation down into a very reasonable zone for a lot of small cap companies there. Plus profitability standpoint, if you see the next 1-2 years projections that are coming in for this range, and I was just seeing various reports on Bloomberg, they're talking about anywhere between 14 to 18% growth in profitability over the next 1-2 years. So that, I think, is kind of instilling confidence back in the small cap space, and which is where in terms of flows you've seen it to be as the second best category in terms of flows that they've got. And from an average 3,000 odd crores that we were seeing entering, this time it's jumped to around 4,000 crores of net flows in small cap.
Exactly. Shweta, now talking about continuing your SIP, although the numbers really are very interesting, retail investor numbers, especially after we look at the outflows coming from FIIs. In the month of April so far, we've seen almost 32,000 crores. They've been net sellers with this kind of a number. Vis-a-vis the DIIs and retail investors are really holding on to it very strongly. But then now, what is the reason for one to increase their SIP? What is the rationale that you might want to give? Because obviously, if you've started investing 2 to 3 years by SIP, you must have invested at market high. Now it's really crucial for you to, accumulate those units, and this entire year can actually be called as an accumulation year. How do you look at why is it important not to stop your SIP right now? You might just want to shuffle up or revamp your portfolio in terms of market caps, move more heavy towards large cap to get more stability. But you always come up with great data, Shweta, which is why I'm asking you if you could just give us some background data-wise.
Perfect. So, going back to basics, the concept of SIP is that it gives you the rupee cost averaging, which means in periods like this, you get that averaging benefit and the number of units you could accumulate would be far more. Second, I have two important, I think, very interesting data points that I can share here. And this is one study that I've done from 2001 onwards. If you see, if someone had invested in SIP, let's say in large caps, Nifty 50, if I take as an example, the first year, there is a possibility that, if I take 5-year blocks of SIP, and the first year when you started, you've made negative returns, right? So 12 installments gone in, you're sitting at negative returns. The negative returns would be an average 20%. If you continue to stay invested and do your SIPs for the next 4 years, the 5-year cumulative, the compounded average return of these SIP would be around 12.5 to 13%, which means what you've lost in the first year, more than that has been covered up in the following years. And this has happened in all instances where the first year would have been a negative return. Moving down to mid and small, let me talk about small cap. There's a high chance that there are those 18-19% instances where the first year of your SIP delivered negative returns for you. The average negative return turns out to be a minus 25-27%. The next 4 years, small cap index also rebounded, and there your 5-year CAGR comes up at around 17.5%. So, this is one telling you that you need to be patient and don't get swayed away by the first year of negative returns in an SIP. As you stay invested for a longer time period, markets rebound. One other interesting data point, if you just see the average rolling returns of Nifty, as long as you are a 7-year plus investor in equities, equities have given positive return. And if I just break it up into different ranges of more than 6%, more than 10%, then there's a 90% plus probability of getting more than what ideally debt would give you over the same time period. So it tells you that you really need to be patient. Don't get fearsome with interim volatility. Continue with your SIPs. In fact, these are the times when you should look at stepping up your SIPs, I would say.
All right. We'll be talking more on this as to why you should not be stopping your SIP, but then we also have our viewer queries on the show today, and I think we should totally go ahead with those queries now, because we'll be running on short of time. Shweta, Avinash Singh's question we'll take first. Okay, he's got a couple of mutual funds: SBI Contra, Axis Small Cap, Kotak Emerging Equity, Parag Parikh Flexi Cap. Currently, he's doing an SIP of 1 lakh. He's an aggressive investor and want to invest for 10 years and would like to step it up also by 10% every year. I do not have him on the phone line, so I don't know what's the corpus he's looking at and the kind of recommendations he's taken from someone, or whether it is his own research. We won't be having any idea. But then, as he rightly said or called himself as an aggressive investor, we can see that in his portfolio as well. But then, okay, he definitely needs some more stability. So would you want to add a large cap to his portfolio?
Yes. So Avinash, I was, actually seeing your portfolio. Now you're doing an SIP of 1 lakh, but your mid and small cap fund put together 60% is getting invested in these two schemes, which means roughly the exposure that you have to the space is around 60%. I would say that is really aggressive. And it not necessarily means that high risk would yield you high returns, right? You need to maintain a balance between risk and return. So look at reducing your exposure to mid small. I think around a 40% odd exposure is good enough. And given the situation also right now, that's what I would suggest. What you can exit, I would say Axis Small Cap and Parag Parikh Flexi Cap. These are two schemes you should exit from. Instead, what you can add for an Invesco India Small Cap Fund, a Canara Robeco Multi Cap Fund. And I'm suggesting you one more scheme to add, which is the HDFC Flexi Cap Fund. So if you split it this way, you'll go a little heavy towards large cap, which is what you need. Plus your scheme level exposure could come down a little. So that's my recommendation to you.